Hi everyone, welcome back to your weekly market update from G2 Financetech. This past week gave us a lot to digest, from stronger than expected earnings to heating inflation data. Let's break it down market by market and share what we think it means heading into the second half of the year. United States. Starting with the United States, it was a mixed bag on Wall Street. The S&P 500 and Nasdaq hit new record highs powered by upbeat corporate earnings, especially from big names like JPMorgan, Citigroup, PepsiCo, United Airlines and Netflix. Even NVIDIA made headlines again, crossing the $4 trillion mark and getting a green light to sell AI chips to China. No signs of slowing down there. But beneath the surface, inflation data caught some eyes. The consumer price index rose 0.3% in June, its sharpest monthly rise in 5 months. Year over year inflation came in at 2.7%, with core CPI climbing to 2.9%. At G2, our take is this: inflation isn't derailing markets just yet, but the trend is worth watching. Higher tariffs might continue to nudge prices up, and if that continues, the Fed might have fewer options to pivot dovish. On the bright side, retail sales bounced back, up 0.6% in June after a sharp drop in May, a sign that the consumer story isn't broken. For now, spending still seems resilient. Bonds and Fed watch on the bond front, corporate bonds outperformed treasuries last week. Meanwhile, Powell's job security briefly spooked markets when rumors swirled about Trump planning to fire him, something that was denied later. Still, just the mention was enough to shake up short term yields. We think the Fed story will remain a wild card through the year. With markets pricing in rate cuts and politics heating up, it is going to be a bumpy ride. Over in Europe, the stock 600 ended flat overall. Trade tensions with the United States are back on the radar, and any tariff threats could be a headwind. That said, we saw some bright spots. Eurozone industrial output jumped 1.7% in May, and the trade surplus widened. Plus, German investor sentiment hit a 3-year high. That's a good setup, but inflation in the UK surprised to the upside, jumping to 3.6%, and unemployment ticked up to a 4-year high. G2's view: Europe is stabilizing but still vulnerable to external shocks, especially US trade tensions and energy price volatility. There is potential but not without caution. Moving to Japan. Markets posted modest gains, but political uncertainty ahead of July 20 election capped enthusiasm. Investors are watching how pro-reform or physically loose the next cabinet might be. Meanwhile, inflation softened, core CPI rose 3.3%, slightly below estimates, and exports fell again, thanks in part to weaker United States and China demand. At G2, we see Japan in a holding pattern. If policy remains supportive and external demand improves, Japan might quietly outperform in the second half. Finally, China. Markets were up, helped by GDP growth of 5.2% in quarter 2, beating expectations. But there is caution in the air. Factory deflation continues for 33rd month, retail sales are soft, and the housing market remains under pressure. With new home prices falling and sales down over 12%, G2 stake. China is growing, but the quality of growth is uneven. We are likely to see more stimulus talk soon, especially if deflation and housing pressures persist into quarter 3. Wrapping up, earnings strength is keeping global equities buoyant, but inflation and political noise, especially in the US and Europe, are creeping back into focus. At G2 Financetech, we think the key word heading into late July is selectivity. Stick to quality, watch central bank signals closely, and don't underestimate the macro risks behind the market rally. Thanks for tuning in. Do not forget to like, share, and follow G2 Financetech for more global market insights. Catch you next week.